Is it possible to create a full fund manager in just one expert advisor? That was the question that I sought to answer when creating our new Longbow Fund Manager EA. I was essentially trying to recreate a hedge fund investing concept, but seeing if I can put the entire thing just in one bot. So effectively trying to create a bot which does not mimic your classic MQL5 scalping strategies, or I don't like grid martingales, but a lot of them tend to be based on that, but instead do something which is based more on buy and hold investing, but in more of a CFD context. So before diving in, I wanted to discuss what is a long-short equity fund. Long-short funds are one of the most common types of hedge funds, and the general premise is to create an all-weather fund. So you want to have an instrument that performs well even when markets are bullish or bearish. So right now, for instance, you can see that equity markets are in a free fall, but if you did a properly constructed hedge fund, and the word hedge is vital here, you would be able to have some portfolios short, so some positions short, some positions long, and effectively in more of a bearish period, ideally your short positions would cover for your long positions, which would be in a loss, and your total equity curve would be relatively flat. So I was trying to think, okay, is there a way to essentially pick some assets which are bullish and some assets which are bearish, but do it all automatically in a systematic way in an expert advisor to be able to have a similar effect, but in a CFD context? So first of all, to determine which assets are bullish or bearish, I went to the Commitment of Traders report. And the Commitment of Traders report is a really interesting publication put out by the US futures regulator, the CFTC, on a weekly basis, which shows the entire market's current positions in longs and shorts. So I can just pull up one here as an example, and we can, let's see, these are the older legacy reports, which I quite like. And here, Commodity Exchange Incorporated. And effectively, as you can see with this report here for gold, they break it down into non-commercial, commercial, and non-reportable positions. And what non-commercial means is this is all the large speculators. So this would be hedge funds, money managers, and just pretty much anybody who's not a commercial participant but still a professional trader. Commercial participants would be producers in this context, so your big gold miners. It would be swap dealers, people who are very actively involved in the actual manufacturing of the commodity. And then we have non-reportable, and this is just a solve for the total. And this typically is referred to as retail or the dumb money here. And what's really interesting is not only can you see their longs and short contracts of all futures in gold, you're also able to see their week over week changes. Granted, you could also calculate this relatively easily from historical data, but you can see that this week, for instance, more people went long gold. However, quite a few more went long short. And that means that the total net positioning from the non-commercial participants was very short. So essentially, to determine if assets are going to be long and or short on a given week, you could effectively go and just look at how the smart money is determining where to allocate their money. And I initially started with both a long and short portfolio, but I actually moved over to a pure long portfolio just because I selected for assets which generally speaking only go up, or not only, but generally go up over the long term. And these assets specifically are the two largest and most popular equity indices, or not two of the largest and most popular equity indices, which would be the NASDAQ and the Dow Jones, the US 30, as well as gold. And the reason why I think it's okay to run a long only strategy here is because with many assets, if you were only going long, there would be a risk of overfitting because you would be having a pretty significant look ahead bias. However, because we know that equity indices are made to go up because they have a rotation of companies, right? So if a company does poorly, it falls out of the index and it's replaced with a company that does well. So as long as the US economy as a whole over the long term will do well, the equity indices from the US economy should go up. And with most indices, as long as the economy is not massively stagnating, which we saw at the Nikkei for a few years, generally speaking, equity indices will go up. Gold, on the other hand, is generally seen as a hedge against inflation. So provided monetary policy continues being in the money printing and debt-driven world, which my fundamental bias is that we're likely going to see quite a few of that, at least for the foreseeable future, we're likely to see a continuous bullish momentum in gold over the super long term. So yes, gold might fall hundreds of dollars in the next 5 years, but the next 20 years, perhaps gold will still be, or I would be surprised if gold is not at higher levels than it is today. So that's my fundamental bias here. So essentially, instead of doing the classic long-short portfolio, I want to pick from these three assets which one of these assets are the most bullish on a given week. And effectively what I did, and I'll pull up MetaTrader now, is I created the Longbow Fund Manager Expert Advisor. And what Longbow Fund Manager does is every week it looks at the Commitment of Traders report, and it specifically looks at the increase in long positions of different traders in the different assets. And then it looks to see which one had the largest bullish increase in positions above a certain threshold. So if like nobody actually increased their net long positions in, or their long positions more generally in any of these assets, it will stay in cash. It won't go long that particular week. But if, let's say, people increase their longs in the NASDAQ by 20% on a given week, it will think that the smart money is likely most bullish NASDAQ, assuming gold went up 2% and the US 30 went up 3% or whatever. It would say that the NASDAQ this week is the most bullish asset. And then it will essentially look to go long the NASDAQ on that given week. And in the case of CFDs, what's really a blessing is that we have unlimited leverage, but the curse is that our fees of holding are exceptionally high. Therefore, the entire premise of this bot was not to just buy and hold, it was to effectively buy at the open and sell at the close to avoid swaps. And essentially all the strategy does, and I'll pull up here so you can see the past couple trades in the NASDAQ, is it'll buy at market open and it will hold until close. And there's also a few other functionalities here where it uses break-even stops. So what this will do, and what I tested a few different versions, but to make it as simple as possible, once we bank 2 Rs in profit, it will move the stop loss by 1 R, so that it will move the stop loss in such a way that we bank 1 R in profit. So 2R, once price goes 2R in profit, it will then move the stop loss so that we secure 1 R of profit, but it won't go very close to where price actually is, as we want to ideally let price run until the end of the day so that we are able to maximize our winners. That's essentially the general premise here. What I found was extremely interesting is that even in bullish and or bearish periods, yes, we have drawdowns, but it can still do exceptionally well, even in relatively choppy price action. And this was it's not quite a long short, it's a long only, but it's a long only with a heavy risk on asset, which is gold. So essentially, instead of taking a short position, it just reallocates to gold during a period of time where smart money moves from risk on assets to more risk off assets. So we're buying assets which generally have a bullish bias long term, but some of them are risk-on assets, being equity indices, whereas the other one is gold, which is more of a risk-off asset. Therefore, during panic or market crashes, capital will often flow into gold. And we saw that exactly here, right? At the initial peak of February, equity markets have been in an absolute free fall. And we had an initial drawdown, but then eventually the bot very quickly started allocating money towards gold as opposed to equity indices. So it started trading here and started allocating money more and more towards gold. And now it has switched back to the NASDAQ because that is where people are more likely to predict a reversal sometime relatively soon. So that's a super interesting premise. And the fact that if we compare this to just buying and holding an index, we're having significantly higher returns. This is like 400% returns since 2020 with only an 8% drawdown. So with let's say around a third of what you would typically see in the buy and hold style drawdown. So that is really, really phenomenal because we're able to have higher returns and lower drawdowns. And the premise behind that is every day we also enter with a stop loss, so our risk is controlled. And this enables us to not be hit by those massive drops in equity markets, which you might see if you were simply trading in more of a buy and hold style. So your risk is capped, your upside is not capped, and you're using leverage to be able to take advantage of larger swings. If you just buy and hold, often you don't want to buy with significant leverage because your drawdowns can be exceptionally nasty. But here, because we're entering with a 1% risk daily, we're able to capture that full range because when that stop loss is tight, we can use leverage and therefore take advantage of a bigger move. So guys, I thought this was a cool experiment. It shows that yes, you can create a fund manager in an expert advisor. It's a bit different than what you typically see on the MQL5 marketplace, so I wanted to share it with you guys. If you're interested in getting this expert advisor, you can book a call for our prop firm bundle, where this is included along with 5 others, so 6 in total, excellent expert advisors, which trade market open breakouts, 5-minute opening range breakouts, as well as 2 of these more fund manager style EAs. Take care, have a great day.